So the firm has been bullish on this AI cycle for well over 2 years. And I think what's really, surprised people of late is not the rate of change on the hyperscaler spending. We've kind of become accustomed to that every quarter. It's the quarterly tradition. I think it's just how much, Tom, the rotations are happening underneath the surface within semiconductors. GPUs leading 3 years ago, memory a year ago, CPUs now. It's like Back to the Future with CPUs. So that's the part that I think is surprising people, not the level of overall spend.
I guess it's a little bit harder these days because it seemed like in the beginning people were just investing in the stocks that were just throwing out these huge CapEx numbers because they were getting into AI. Now it seems like the market's trying to discern winners and losers. We saw that last week with some of the big Mag 7 kind of names reporting. How do you guys think about winners and losers, particularly in software?
Yeah, Paul, it's such an important question. And when you think about it, 2 years ago, we made the call that Mag 7 would act as a monolith as everyone got excited about the dream of ChatGPT. A year ago, we said it would pivot to a Peloton. And you'd see more dispersion. And so, to your point, that was the case several weeks ago throughout earnings season. I think, look, for us, when you think about the spectrum between winners and losers, I think it's really a long-term idea. We're just getting going in this cycle. But how can you not be, on the one hand, bullish about all the spending beneficiaries semis power and not also be enthusiastic about the applications? And that's where we're finding values today. Look at financials, healthcare, look at parts of software, not all software, but selectively, those are the ideas for new money that make sense right now.
Outside of technology, where are you guys seeing opportunities here?
Yeah, so definitely as mentioned, we're looking for reasonable valuations with some of the quality financials, healthcare. Look, everything fundamentally looks sound for financials. Capital markets, deregulation, perhaps the curve re-steepening as Iran continues to seemingly de-escalate. But why is the space underperforming? It's all about the midterms. And we've made this point in the last year. The market goes through these fleeting moments of treating policy and geopolitics like pop-up ads. And so we want to maybe get past the midterm results to get even more bullish financials, but we think you have to be there.
The midterms, a lot of strategists are calling out, that's generally not great for risk assets because just, if for nothing else, midterms often suggest a little bit of uncertainty out there. And is that something that you guys plan for or try to look past, I guess? Yeah,
and so I think it's right. I think typically the midterm year on average is flattish for markets, followed typically by assuming all else equal is positive in the economy, assuming a better year thereafter. And so look, we don't think it's going to be really anything different this time. As we know, we had a V-shaped down on Iran and a V-shaped up. So we've come a very long way in a quick amount of time.
But the bottom line is most people sold at the top, and once again, they 3, 2, 1. They bought at the top and sold at the bottom. Whatever the math is. I want to know with Morgan Stanley right now how you deal with a clientele that's just afraid. Even if it's an indirect hedge. Everything's like, yeah, I want to participate, but. How does Lisa Shallot and you deal with the but of the fear that's out there?
Yeah, and so look, what we would say is to, simply tried and true playbook of staying diversified, but also thinking outside of equities, we've been bullish on real assets, and that's been a fantastic hedge this year. Secondly, we've said within the kind of broader high net worth fishing pond, long-short hedge funds, and they've had a tremendous run in terms of exploiting some of the volatility. So, Tom, to your question, it goes to outside of thinking traditional stocks and bonds.
Do you have an oil call?
We sure do have an oil call, and as you likely know, Martin Ratz in Europe owns that call for us on the commodity front. And look, he's marked up his estimates and his outlook higher as we've gone through the issue. The issue is even if we were to open the Strait of Hormuz tomorrow and it's like 100% open, there's been physical infrastructure damage, and there's still going to be a lag effect in terms of oil prices and particularly gas prices.
They're saying Qatar in LNG like 5 years.
They lost 20% of one of the particular LNG assets, and it's going to be offline for several years. So to your point, there is going to be a lag effect in terms of not just seeing the commodity price complex come down immediately. And so I think Martin's new price range is between $90 and $100 for the rest of this year.
Wow. So what's in the bond market here? I mean, we're looking at yields. I mean, Tom and I were on that 5% watch on the 30-year just a few days ago. are we taking credit risk here in the fixed income market?
Yeah, the issue with credit is that you also have this deluge of issuance coming this year, as per M&A.
Because of you guys are issuing on this.
Right on. Talking our own book.
Yeah.
As per the M&A cycle, as well as the financing of data center construction, which we all know continues in earnest. And so, look, I would say within the bond market, take it with a grain of salt from an equity PM. But we've just simply counseled folks, once you get above 4.5 on the 10-year, you can nibble. But we would also say, look, longer-term AI, disinflationary. Iran, perhaps a growth scare down the road, that could create a contraction in yields. And so we wouldn't get too aggressive before 4.5.
Right.